have in class quizzes, which you need to write. So we'll have a midterm test, which will follow the online part. And the final test, the ordinary final test at the end of the course, which will follow our main part of the course. Today we have the first lecture, and also at the same time, you should start watching the online lectures. I will show you the link. So the online part of this course is like a complementary part to the main part, but it's not a prerequisite for the main part, because basically the main part doesn't require that material to know, but that material may be just some extra material for your just more general knowledge of the international finance. The online part is pretty easy. It's much easier than our main part. It's more descriptive, but it is very interesting, I should tell you, because in the online lectures, the teachers from a good US university, they talk about a currency crisis, different issues in international finance, like exchange rate fluctuations. There is no mathematics in that part. It's only descriptive. It gives you fundamental concepts and some stories about international finance. So it's easy to follow and pretty interesting. In our main part, we'll study more like models or academic papers about currencies or exchange rate determination. So our part will be a bit more technical than the online part. So, but you must do both parts, and the online lectures are followed by the test, which is obligatory to write. So you cannot miss this test. If you miss, you will have to retake it again. Okay, what else? So our classes and lectures will be in Zoom as now. Yeah, so this is the grade determination. You will have 4 in-class quizzes, which will constitute like 20% of the final grade. Then there is class participation, which means active participation in classes. Of course, it's a bit difficult in Zoom, but the teachers will figure out how to give you grades for your activities in the classes. Then at the end of the course, you will have a small group research project, which will ask you to create some trading strategy which involves different currencies and test its performance. So in the course, we'll study several trading strategies, the main currency investment strategies, and then I will give you a task to build a simple trading strategy and try to estimate its profits in the past and its risks. And in the last class, you will need to present this project. The project is in groups. You may choose your group yourself, and the group should consist of like 3-5 people, not more than 5 people. You can do a solo project if you wish as well, but it's better to do it in groups. Then we'll have a midterm test. Again, we'll announce the date of this test later on. Probably in like 3 or 5 weeks. So in the middle of the course, we'll give you some time to watch the online part, and then we'll have this test. And the final test, which is the 50% of the final grade, will be during the session or maybe the week before the examination session. By the way, if you miss quizzes, which are held in classes, and if you miss a quiz due to an illness, then your final grade will just be recalculated proportionally. So it will be increased proportionally using this formula. However, you cannot miss the midterm test or the final test. You will have to write them in any case. What else? So these are the main textbooks. Again, I will upload the textbooks. I have all of the textbooks in the electronic format. So I will upload the textbooks in the Google folder, and you can download them. This is the link to the online part. So the online course is provided by the lecturers of George Mason University in the USA. You just click on this link, and it doesn't require, so that course doesn't require any registration, any payment, nothing. You can just watch the video lectures, and that's it. And after you watch them, we will have our round test. So you do not need to take any tests online on that platform. We will have our round test, which we will create ourselves based on that material. And we will figure out the format how to hold this test in this distant form. And finally, in the syllabus, I have added all the research papers which we will cover in this course. So you see there are many of them, but you do not need to read all of them. And that's a lot actually. And probably you will have to read a couple of these papers in order to understand the ideas behind the trading strategies when we come to them. These references are more for your curiosity. If you are interested to learn about this stuff deeper, then you can read the papers and get a lot of details from the papers. Sorry. So there are a couple of my papers about this stuff because I also used to work in the international finance area. But many other papers by very famous authors, actually. And this is the course outline. So this is the line part, which is pretty simple, as I said. It's an introduction, exchange rates, currency issues, euro crisis, international trade overview, crisis and responses to them. Now, the online part is very descriptive. And the main part, this is the syllabus of our part, of our regular lectures. The overview of the foreign exchange market, an asset approach to exchange rate determination. This will be like a theoretical macroeconomic type model. Again, very simple. And then we'll turn to the relationships between money, interest rates, exchange rates. So this is also about exchange rate determination. Then we will study different currency investment strategies. So this is a big topic, actually. We'll talk about different currency investment strategies. So how to make money on currency trading. And then we'll talk about inflation and exchange rates in the long run, financial globalization, international asset pricing. So these are like small topics for bigger picture. So there was a question in the chat. The syllabus is in this chat. I don't know if you do not see the syllabus. Then maybe I can upload it once again.
It can be seen. It's in the Zoom chat. Simply file.
Yeah, so I don't know. Maybe somebody joins later and doesn't see the chat, the previous chat. I don't know. Can you see the chat from the beginning? So I have uploaded the syllabus and the first lecture note in the chat. Okay, maybe I will upload it once again. Sorry, it doesn't work. I have uploaded the syllabus again. So probably somebody who joined later doesn't see the first. You should see it actually. Okay, anyways. So guys, do you have any questions regarding this administrative stuff? Or is everything clear?
Can I ask in Russian?
Yes, of course.
А можно уточнить, а насколько этот курс сложнее или проще Финека? Просто чтобы примерно ожидания построить.
Сложный вопрос. Мне
Насколько...
кажется, он, наверное, будет проще немножко, чем Финек. По крайней мере, обычно он более дескриптивный, тут меньше теоретических моделей у нас будет, больше будет научных исследований, но которые, соответственно, вы не должны делать, а вы просто должны их, понять основные идеи этих моделей, вернее, этих статей, этих теорий. То есть, наверное, он будет проще с фундаментальной точки зрения, чем финансовая экономика. То есть здесь, я понимаю, по финансовой экономике там больше моделей и больше в экзаменах таких задач, где нужно подумать, немножко покрутить модели там в голове, да, что-то такое придумать, как применить модель именно в данном контексте задачи. Здесь этот курс, мы специально не делаем таким сложным, потому что это электив более продвинутый. То есть, с одной стороны, здесь материал более углубленный, но с другой стороны, чтобы вас не перегружать, мы его делаем попроще, и экзамен, он более дескриптивный, то есть там больше вопросов типа essay type, где просто нужно что-то, описать, какие-то стратегии, например, инвестиционные.
Спасибо.
Обычно в плане оценок этот курс дается проще студентам, я имею в виду по итоговым оценкам, по нему меньше пересдач, меньше проблем, так скажем. Но опять же, с другой стороны, его и выбирают уже только, как правило, только те, кто больше заинтересован в финансах и лучше разбирается в этой области.
А сколько пересдач было в прошлом году?
Почему?
По
международным финансам? Я даже не помню, мне кажется, не было. Или была одна, может быть. Да, была одна пересдача человека, который просто не явился на экзамен.
А средний балл, может быть?
Не, я не помню такой статистики. Средние баллы, вы же видите, мы их там можем двигать туда-сюда посредством нормировки. Наверное, вы в учебной части можете спросить. Или я могу, если вам очень интересно, могу потом посмотреть, напишите в Телеграме. Я потом посмотрю, вам скажу.
Хорошо, спасибо.
Говорю, Корл садится. By the way, do we have any foreign students here? Just to know whether I can switch into Russian. Is there anybody who doesn't speak Russian? Okay, probably no. So if we have some difficult stuff or you do not understand something, you may ask me to switch into Russian and I can explain the same stuff in Russian if there are no foreign students, okay? So let's now turn to the main lecture. Can you see my slides?
Yes.
Yes.
Okay. So this is just the introductory slide as well, with the forms of study and control and grade determination and textbooks. We have covered this stuff already. So now let's turn to the first topic. This is just the introduction to the course. It's very basic, very simple. You probably know this stuff already, but still I need to remind you just to make sure that everyone knows what we are talking about. So today we'll talk about an overview of the foreign exchange market. By the way, the foreign exchange market, or the FOREX, is the market where different currencies are traded. So remember that in financial economics, we talked about various markets, asset markets. So we talked about stock market, bond market, derivative market. And in this course, we'll talk about the foreign exchange market. But the stuff which we will cover will be pretty similar to other markets, because currencies are also investment assets, like stocks or bonds. So what's the exchange rate? It's the price of one currency in terms of another currency. Or it can be viewed as the price of country's money in terms of another country's money. It's like an asset price, right? Because an exchange rate is the price of a foreign currency in terms of your domestic currency, for example. So it's like a price of a foreign asset, and hence the principles governing the behavior of asset prices also govern the behavior of exchange rates. We can view the exchange rate. So it's not like it's not a macroeconomic concept. It also can be viewed as a financial concept. It's just the price of a foreign asset, and that's it. And this is actually the view which is more and more predominant in international finance and in finance in general. That we look at exchange rates not as a macroeconomic concept, which only can be derived from macroeconomic models, but it is more an asset price, and the rules and models and principles which govern the behavior of asset prices also affect the behavior of exchange rates. The same like overreaction or underreaction, as we talked in financial economics, they also relate to exchange rates. So today's exchange rate is closely tied to people's expectations about the future level of the exchange rate, because the exchange rate is like the current price of a foreign asset, and it should reflect the future expectations, what we will get. So a similar present value formula may be applied to estimate exchange rates, as we applied to all other assets. News about country affect the exchange rate in the same way as news about a company affect the stock prices. And also we can talk here about the efficiency of the market. Remember that in the last lecture we talked about the market efficiency, that some news are incorporated into prices quite quickly. So the same relates to exchange rate, and foreign exchange market is very efficient in that sense. So the news, the relevant news about countries or about political situation, different anything actually, they affect exchange rates very quickly. So even quicker than in the stock market, because the forex market is very big, very liquid, and very dynamic. Oh, sorry. Yeah, so the exchange rate can be quoted in two ways: a direct exchange rate or indirect exchange rate. So the price of the foreign currency in terms of the domestic currency, like in Russia, the price of dollars in terms of rubles, this is called the direct exchange rate or direct quotation. Прямая котировка. It is also called American quotation. Then if we quote in the other way, like the price of the domestic currency in terms of the foreign currency, this quotation is called indirect quotation or European quotation. The indirect quotation is used, for example, in the UK, where you will see in the banks, they also quote like £1 equals that number of dollars or that number of Swiss francs and so on. So they quoted per £1 in the UK. In most countries, we use the direct quotation. Like $1 costs that number of rubles, €1 costs that number of rubles, 1 Japanese yen costs that number of rubles, and so on. And in this course, we will also use the direct quotation, but you need to be careful because in some textbooks, different quotations are used. So pay attention to which quote is common in that textbook or in that paper, because depending on this, the meaning of appreciation and depreciation of the currency will be different. Yeah, so what's a depreciation, for example? A depreciation of ruble against the dollar is the fall in the dollar price of rubles, or an increase in the ruble price of dollars, right? So it's an increase in the direct quotation of dollar or a decrease in the indirect quotation. So if, again, if the dollar exchange rate increases in Russia, so the $1 costs more rubles, it means an appreciation of dollar and a depreciation of ruble. So an increase in the direct quotation is a depreciation of the domestic currency and appreciation of the foreign currency. But the opposite would be true if we used an indirect quotation. So a decrease in the indirect quotation means a depreciation of the domestic currency and appreciation of the foreign currency. So be careful here on which quotation you use in order to understand whether we have a depreciation or appreciation of the respective currency. A depreciation of country's currency makes its goods cheaper for foreigners, which is obvious, and hence it affects net exports and capital flows and so on. Then an appreciation of ruble against the dollar is the rise in the dollar price of rubles, or a decrease in the direct quotation and an increase in the indirect quotation. So it's the opposite, right? The appreciation of ruble means that ruble is more expensive, is stronger against the dollar. It means that the dollar is weaker. So if ruble appreciates against dollar, it means that the dollar depreciates against ruble. So the price of dollar is decreasing, the exchange rate is decreasing. If we use the direct quotation, and increasing if we use the indirect quotation. And the appreciation of country's currency makes its goods more expensive for foreigners. As I said already, depreciation of ruble against the dollar is the same as appreciation of dollar against the ruble. So it's always like the two-way relationship. If one currency appreciates against the other currency depreciates against that currency. Okay. Okay, now the foreign exchange market. So this is the market in which international currency trades take place. So all international currencies are traded. This is a very big market. It's one of the biggest markets around the world. However, I'm not sure, maybe cryptocurrency market is now even bigger because it's becoming huge, the cryptocurrency market. But I don't know the exact statistics. But anyways, the Forex market is very big and very liquid market. There are many actors who trade on that market, usually the commercial banks, which act as foreign exchange dealers. In other ways, they trade on the Forex market, and then they provide these services to the exchange, foreign exchange services to individual customers. So they engage in interbank trading at the wholesale market, and then they offer retail bid and ask prices to bid and ask exchange rates to customers. You can always go to the bank to exchange your currency, right? And then the bank acts as the dealer. The bank supplies this service to you, but because of this service, the bank earns the bid-ask spread, the difference between the bid and ask prices, which are the prices at which you buy the currency or sell the currency. And of course, this difference constitutes the profit of the bank. And then there are corporations which engage in international trade. So these companies, for example, have revenues in foreign currencies or expenses in foreign currencies. So they have to convert big amounts of foreign currencies into their domestic currencies for the transactions. So they also engage in the trade on the Forex market to sell, for example, foreign currency revenues, or to buy some foreign currencies to pay expenses, and so on. Then there are non-bank financial institutions like asset management firms, mutual funds, hedge funds, insurance companies, pension funds. So different kinds of financial intermediaries are also active players on the foreign exchange market, mainly because they want to make money on that market. So they participate in this market for speculative purposes mainly. They buy foreign currencies and sell them and earn money on these transactions. So this is their main aim, to participate in the Forex market. Then there are central banks, which in most cases just intervene in that market in order to manipulate the exchange rates. So you know probably from macroeconomics courses about different exchange rate regimes, which are common in different countries. So when the exchange rate regime is like managed floating exchange rate regime or fixed exchange rate or a corridor, in all these cases, central banks intervene in the Forex market and either supply foreign currency reserves or buy extra foreign currency in order to maintain the exchange rate on some level, on the target level. And even when we have a floating exchange rate regime, still quite often central banks intervene and manipulate the exchange rates when there are very significant deviations of the very significant fluctuations of exchange rates, because significant drops in exchange rates or increases, on the other hand, they are not attractive for companies and for the countries. So central banks try to get rid of these huge fluctuations. And finally, there are individuals. Individuals also can participate in the Forex market directly, so they do not necessarily buy and sell foreign currencies through commercial banks. They can do this directly on the Forex market if they have an account, and they can trade for different foreign currencies, also in most cases to speculate on exchange rate fluctuations and to earn some profits. Okay, so the main currency which is traded in the forex market is the US dollar, and it's called a vehicle currency. A vehicle currency means that most currencies are quoted relative to the US dollar, and if you want to convert, for example, I don't know, ruble into Brazilian real, you need first to buy dollars, so to convert rubles into dollars, and then dollars into Brazilian real. So there is no direct quotation between rubles and Brazilian reals. So ruble has quotations against just a few currencies in the forex market. So you can like buy dollars, euro, what else? Probably Swiss franc. Then I'm not even sure about the Swiss franc. Then I know you can buy like a Kazakh currency, Belarus rubles, and I think that's it. So not many currencies can be bought directly for rubles because simply there is no quotation on the forex market. So in most, and this is true for many currencies, except for maybe the several biggest currencies which have quotations against all other currencies. So in for most currencies, you first need to buy dollars, and then you can convert dollars into other currency. The euro and the yen, Japanese yen, are the next most popular currencies in the forex market. So these are the three biggest currencies, three most popular currencies. But then, of course, we have a lot more other currencies which are traded. Now, the bid-ask spread is this follows this formula: is the ask rate minus the bid rate divided by the ask rate, and this is basically the spread. So when you buy a foreign currency, you pay the ask rate. If you sell the foreign currency, you pay the bid rate, and the bank, and usually the difference is the profit of the bank which supplies this service to you. And for you, this is like a cost, the bid-ask spread. So whenever you buy or sell some foreign currencies, you will always pay this cost. So this is the main type of the transaction cost in the forex market. It's the bid-ask spread. And these are the factors which affect the how wide is the bid-ask spread for different currencies, because it's different for different currencies, obviously. And so it is different over time. It fluctuates over time, and it fluctuates across different foreign currencies. So the factors which affect the spread are the costs of processing orders, just some transaction costs for the banks. Inventory costs is the opportunity cost of holding the currency, the respective foreign currency. This is important cost because if some currency earns a lot of high interest rate, then if a bank holds a significant amount of that currency in the reserves in order to supply you that currency on demand, then the bank will forego this interest. And obviously, this interest is the opportunity cost of holding that currency. So the bid-ask spread would be higher for that currency if the local interest rate in that currency is higher. Then the competition among banks affects the bid-ask spread in the respective area in the country. For example, in some countries, the competition is quite tough. Like there are many banks supplying these services, and hence the bid-ask spreads would be quite low. But in other countries, the competition is low, and then banks can charge high bid-ask spreads. Or, for example, it may also affect bid-ask spreads across different currencies. Like, for example, dollar and euro, you can buy dollar and euro from all banks, right? So there is high competition to buy like dollars or euro, such common currencies. Hence, the bid-ask spread for these currencies would be low. If you want to buy some rare currency, I don't know, some African currency, which is not supplied by many banks, then there will be very very low competition for that currency among banks, and then the bid-ask spread would be very high, because basically there is just one bank which supplies that currency from which you can buy that currency. So that bank will be like a monopoly and will be able to charge very high spread and to earn money on this. The next factor is the liquidity of the currency. Obviously, the more liquid is the currency, the lower would be the bid-ask spread, because it again relates to reserves of that currency. So if currency is very liquid, it is traded in high volumes on the market, on the Forex market. It means that banks can easily buy and sell this currency on the Forex market. Then the banks would not need to have high reserves of that currency, because they can always buy that currency. If they have a customer who wants to buy that currency from the bank will easily go to the Forex market and buy that currency quickly. So banks will hold low reserves, and as a result, the bid-ask spread would be also low. If the currency is not liquid, so it's not easy to buy that currency on the Forex market or to sell, then banks will need to have higher reserves of that currency, to hold higher reserves of that currency on their accounts, and then the bid and ask spread would be, of course, higher. And the final factor is the currency risk, which can be measured by volatility of the exchange rate. Obviously, if some currencies have very volatile exchange rates, so there is high currency risk, then the bid and ask spread would be higher, because when banks hold reserves of that foreign currency, the exchange rate may change significantly during that time, and the bank may lose a lot of money. Hence, the banks will charge high bid-ask spreads in order to cover those losses. When volatility is low, so the currency is pretty stable, then it's fine, and banks do not have high risk, and hence the bid and ask spread would be lower. This is also, you can see this actually, you can monitor the situation over time. When, for example, in Russia, there are periods when the volatility of the exchange rate is very high, like very uncertain situations. For example, during the COVID crisis last autumn, no, in the spring, even in the spring, when the COVID crisis just started, we had huge volatility of exchange rates, right? And when we have very high volatility of exchange rates, and it means high uncertainty what the exchange rate will be in the nearest future. So this is a very high currency risk, and as a result, you can see straight away how banks widen the bid-ask spreads. So in times of high volatility, the spreads just widen a lot. So it's very unprofitable for you as the customer to trade foreign currencies in those times, because basically you will pay very high, you will lose this spread to the bank, and the bank will earn it. they affect the spread, and the spread in turn affects your profit from trading foreign currencies. So it's important to take the bid and ask spread into account when you follow some trading strategies in foreign currencies, because usually a trading strategy involves buying foreign currencies and selling them and rebalancing your portfolios all the time. But whenever you rebalance your portfolio, you will always lose this bid and ask spread, because you will buy at one price and sell at a lower price. And I mean, you will like buy at the ask price, sell at the bid price, and then you will always lose this difference, in addition just to the fluctuation of the average exchange rate over time. So it is important to take into account the spread when calculating the actual profits from a trading strategy. Yeah, this is also one of the reasons why it's not profitable to rebalance currency portfolios often. So it doesn't make sense to rebalance them daily, for example, because basically the bid-ask spread will eat all of the profit. Okay. Now, so let's move forward about some other terminology. Exchange rates can be of two types: spot exchange rates and forward exchange rates. It's like in all other markets, we have spot price and forward price. Remember that, right? So the spot price is the price which is used in the immediate transactions or spot transactions. Like if you buy a foreign currency now, you will pay the spot exchange rate for that foreign currency. A forward rate is the rate which is quoted for a delayed transaction. So you will sign the contract today, but the actual exchange of the currencies will take place after some time in the future. And these are the most common days, but it depends on when you sign the forward contract. So the forward rate is the exchange rate which is fixed in the forward contract, right? And the forward contract is the contract which is signed today, so all the conditions are written today, but the actual transaction will take place in the future. So when you want to sell pounds for dollars, for example, on a future date at a forward rate agreed on today, it means that you have sold pounds forward or you have bought dollars forward. So this is just the terminology. When you buy dollars and pay pounds, right? So you buy a dollar forward. It means that you buy dollars in the forward contract, but paying your domestic currency. But the domestic currency in this example is pounds. So, or you can say that you have sold a pounds forward. So these two phrases mean the same, basically, for this transaction. Yeah, forward and spot rates are not necessarily equal, and you know this from financial economics course, right? You remember probably the uncovered interest parity condition, which shows how the forward exchange rate is defined, is estimated. So you remember that well, of course, we'll cover this many times again in this course, but you should remember from financial economics course that the forward exchange rate equals the spot exchange rate multiplied by the ratio of the interest rates in the domestic currency and in the foreign currency. Right? So basically, this is the covered interest parity relationship, which shows the pricing of forward contracts through no arbitrage condition. And from that relationship, you can see that forward and spot prices are linked, but they're not exactly the same. Basically, they are different by the ratio of the interest rates between the two countries. But over time, they move very closer. So if you want to estimate the correlation of those, of the forward and spot exchange rates over time, the correlation will be close to 1 for any currency. But the exact level will be different. And this is just an example of a spot and forward exchange rates between dollars and pounds. I took these examples from your textbook, and the textbook is written, I think it's in the US textbook. So the two main currencies for the US citizens are dollars and pounds, or dollars and euro in more recent textbooks. So this is why we have this charts between these two currencies. Anyways, you see here that the blue line is the spot exchange rate and the red line is the forward exchange rate. And you see that they move 1 for 1, basically. So there is very close correlation. The correlation between these two rates is close to 1. However, you see some periods where there is a small gap. And if we had other pair of currencies, I don't know, for example, dollar and Japanese yen, or even more ruble and Japanese yen, and we would plot spot exchange rates and forward exchange rates between ruble and Japanese yen, you would see a huge gap. Again, the correlation would be very close over time, but you would see a huge gap between the two. Why? Because the difference in the interest rates and the local interest rates is very significant between Russia and Japan. But here, the difference in the interest rates between the US and the UK is almost zero. They have the same levels of exchange rates, more or less. And this is why, except maybe some periods of time here. This is why when the interest rates in the two economies are very close to each other, then the spot and the forward rates would also be very close, like in this example. Now let's talk about some other currency derivatives. Besides forwards, so a swap, a currency swap, is usually in the most common type of a swap is the spot sale of a currency combined with a forward repurchase of that currency. So it's just like a two-way exchange. You sell the currency and you buy it back after some time. So this is called a currency swap. And this swap results in lower broker's fees than the two separate transactions, and this is why sometimes they are popular. But usually swaps are OTC contracts. And for currency trading, they are quite popular because, especially for multinational corporations, which need to regularly buy or sell foreign currencies. So they use these swaps to manipulate their exchange rate risks, to hedge the exchange rate risks for the future. Because again, when you sign a swap contract, you specify the spot exchange rate and the forward exchange rate for the other side, for the other transaction. So you fix the exchange rates, and hence you get rid of the exchange rate risk. Okay, a future contract is like a regular future. It's an obligation to buy or sell a specified amount of foreign currency for the domestic currency on a specified date in the future. So when you buy, I don't know, a future contract on Swiss franc, it means that you will be buying Swiss francs in the future. for the exchange rate, which is called the future exchange rate, which will be determined today in the future contract. And you will pay by your domestic currency, obviously, by rubles. Yeah, so unlike a forward contract, you can resell the future contract because the future contracts are traded on the FOREX market, on the futures market, on the derivatives market. So future contracts can always be bought or sold until their expiration date on any time. You can buy your future contract, which will mean that you will be buying that foreign currency in the future. But it doesn't mean that you need to wait until the expiration of the future contract and actually buy that foreign currency at the future exchange rate. You can resell your future contract later on any date, and then you just get the profit as the difference in the future price. That's it. And this is how why futures are traded in most cases. It's nowadays it's not that common that futures are used to buy or sell the actual amount of that of the foreign currency. I mean, sometimes companies do need to buy or sell a foreign currency, so they need to exercise the future contract on the exercise date. But that's not the only reason why futures are traded. And the main reason for trading futures is the speculative reason. Companies or funds, they just buy futures when they think that they are underpriced, and then they wait until the price increases, the exchange rate increases, the future exchange rate, and then they sell these futures without before expiration, without exercising the future contract, and they simply get the difference as the profit. This is the main reason for trading futures nowadays, speculative reason. Okay. Then there are currency options or foreign exchange options, which give the owner the right to buy or sell the specified amount of foreign currency at a specified price at a specified time in the future. Again, the option contracts, because they give the right to the buyer to buy or sell the foreign currency, the option contracts priced themselves as the contracts. So the option premium, the buyer will pay the option premium for the option, and the option will be exercised at the strike exchange rate. So the strike price, or the strike exchange rate in this case, is the exchange rate at which the option will be exercised on the exercise date or expiration date. Yeah, by the way, most foreign exchange options are American type options, so they can be exercised prior to maturity. They're not European type options, but American type options, which can be exercised prematurely. Option contracts can be also like put and call options, right? So an option to buy the foreign currency is the call option. An option to sell the foreign currency for the domestic currency is the put option. So that's the same terminology as in other asset markets. So we have put and call options on foreign currencies, different foreign currencies, which are American type, which are exercised at the strike price on or before the expiration date. The option seller is required to sell or buy the foreign currency at the discretion of the options buyer, owner, and the option seller basically carries all the risks, but the option seller is compensated by the premium, because the premium is the amount of money which the option buyer pays to the option seller, and the premium will cover the potential costs for the option seller. Then options can be written on foreign exchange futures. So these are options on futures on foreign currencies. They are also quite popular. And another type of derivative on the Forex market is the structured note, which is usually a structured note is an OTC derivative, over-the-counter derivative, which is usually issued by some banks. And the payoff on the structured note is usually a function of some bundle of currencies. So usually the structured notes are written not on a single currency, but on a bundle of currencies or some currency index. And the payoff is usually a nonlinear function, which depends on the exchange rate of this bundle of currencies, and has some strike price. So there are a lot of different types of structured notes, and so they have so any structured note, a new structured note which is issued, is usually it usually has some specific characteristics. So they're very different. All of them are very different notes, and you should see the conditions of the note carefully in order to understand how the profit function is determined. Okay, finally, I would like to talk about non-deliverable forward exchange trading. This is the most common type of trading on the Forex market, is when forward contracts or future contracts are traded, but there is no delivery of the actual currency. As I said, in most cases, investors do not need the actual delivery of the foreign currency because they only want to speculate on the expectations of exchange rates. That's it. But also, some currencies are not deliverable by law. So, for example, like China's currency or Taiwan's, Indian or Russian ruble as well, these currencies are not easily deliverable abroad. So you cannot, like by law, you cannot transfer these currencies abroad. How foreigners can trade in these currencies if these currencies are non-deliverable? Very simply, they can trade using non-deliverable forward or future contracts. In a couple of words, it simply means that investors can buy the forward or future contracts on these currencies, and at the expiration date, they just get the difference between the exchange rates, between basically the forward exchange rate and the spot exchange rate. So the difference will be paid in the foreign currency, for example, in dollars, to the account of that investor. So this would be like as if that investor actually received the foreign currency and sold it on the spot market, for example. So let's have an example. You will see it easier. So imagine that General Motors, which is a US company, has just sold some car components to China, and in 3 months it will receive the dollar equivalent of 10 million yuan. Yuan is the Chinese currency. So General Motors is supposed to receive 10 million yuan, but it cannot receive 10 million yuan because yuan is a non-deliverable currency. It cannot be transferred to the US, the yuan itself. So it will have to receive the dollar equivalent of that amount. However, there is a risk, right, that the exchange rate will fall and it will receive less dollars in 3 months' time. So General Motors would like to hedge this risk. So would like to fix the exchange rate for the future. For example, the spot exchange rate now is 6.8 yuan per dollar. So $1 is 6.8 yuan. Yuan is appreciating, and it is expected to appreciate, and it could be anywhere between 6.7 and 6.5 yuan per dollar in 3 months' time. So this is the current spot rate, and this is the corridor for the expected expected spot rate in 3 months' time. So you see it is falling, right? It is expected to fall because yuan is expected to depreciate. Oh, sorry, yuan is expected to appreciate and dollar is expected to depreciate. This is why it is lower, because this is the price of dollars. So if it's lower, it means that yuan is appreciating. Obviously, General Motors would like because General Motors will receive the dollar equivalent of 10 million yuan, it would be interested that yuan appreciates a lot to 6.5, for example. If yuan appreciates to 6.5, it would mean that it would get more dollars. However, yuan may appreciate to 6.7, which is not that attractive to General Motors. So General Motors, for example, would like to lock in the forward exchange rate of 6.6. So in between, would like to fix this exchange rate for the future delivery. And how it can do this? It can sell a 3 months forward contract on 10 million yuan at this forward rate. General Motors is selling a forward contract on 10 million yuan. It means that it will be selling yuan and receiving dollars. However, General Motors doesn't have actual yuan in hands and will not have yuan in hands because it will receive the dollar equivalent of this amount of yuan. So what happens at expiration? In 3 months' time, General Motors needs to pay or receive the difference between the number of dollars it actually receives here and the amount it would receive if the exchange rate were exactly 6.6. In other words, so basically if the exchange rate is 6.5, then the General Motors would receive, you need to divide 10 million yuan by 6.5 yuan per dollar, and then you would get the number of dollars which General Motors would receive. But anyways, so if the exchange rate is this, General Motors would receive more dollars, but it would need to pay to the buyer of the forward contract the difference between 6.5 and 6.6. So the extra profit, it will have to pay the extra profit, and in the end, it will mean that it will just receive 10 million divided by 6.6. If the actual spot rate is 6.7, for example, then General Motors would receive less from that company, but at the same time, it will receive the difference between 6.6 and 6.7 from the forward contract. So again, the overall revenue for General Motors would be like 10 million yuan divided by 6.6 exchange rate. So basically, what happens here? Once again, because yuan is non-deliverable currency, General Motors would not receive yuan. In this case, it would receive the dollar equivalent at the spot exchange rate, but also due to the selling of the forward contract, it would receive or pay the difference between the spot exchange rate and 6.6, the forward exchange rate, and that difference would compensate for the extra profit or loss earned here. And as a result, the overall profit would be as if General Motors receives 10 million yuan at 6.6 exchange rate. And that's it. So all transactions would only take place in US dollars. So yuan will not be affected here, will not be involved in these transactions. So this is how companies can hedge currency risks by using non-deliverable forward contracts. Okay, finally, I would like to talk a little bit about the Forex, like the factors which affect foreign exchange market and the exchange rates. And this is just the list of factors, like quite big list of factors, but we'll talk about the factors in the next lecture in more details when we talk about exchange rate determination. But you see that there are so many different factors which affect exchange rates, all factors which affect international trade or current account, all factors which affect international capital flows or capital account. All these factors affect exchange rates in the end through the supply and demand of in the Forex market. So we'll talk about this stuff in the next lecture. And this is a very, very brief history of the Forex market. Just initially, this is the time when we start thinking about exchange rates. Initially was the gold standard when all currencies were fixed. Basically, in different countries, we had different currencies, but they were all fixed to gold at constant exchange rates. So in those times, the exchange rates were fixed between different countries. And as a result, it does make sense to study the exchange rate fluctuations because basically there were no exchange rate fluctuations. Then there was the breakdown of the gold standard in 1914 due to the First World War. And after that, there was so-called Bretton Woods Agreement, which was also kind of a fixed exchange rate regime. So again, in those times, we do not study the Forex market because the exchange rates between countries were fixed and there were no volatility, no exchange rate risk. So only after the breakdown of the Bretton Woods Agreement, we have this modern era, современная история в международных финансах. And this is the time when we start to study the foreign currencies, the exchange rates, their fluctuations, their determination, and their risks. Because the floating exchange rate system started from 1973. And you will see most papers, in academic papers, which study big samples of currencies, of foreign currencies. The data starts usually from 1974. Because this is basically the start of the more or less floating exchange rate regime. But again, in those times, only few countries had floating exchange rate regimes. Most countries were still pegged or fixed. But then many countries over time relaxed their exchange rate regimes. And nowadays, in most countries, we have more or less floating exchange rate regime. And this is why nowadays it is more interesting to study the exchange rate determination because exchange rates are allowed to float. And as a result, we have risks risks that the exchange rate will jump in some direction. But still, I should say that even though in most countries nowadays the exchange rate regime is floating officially, still central banks sometimes intervene to manipulate exchange rates. But this is less and less common. So basically, this is the start of our history of the foreign exchange market, because before that we had fixed exchange rates and there was basically nothing to study. Okay, guys, so that was like the short introduction into the forex market and foreign currencies. So in this course we'll study the exchange rates, their determination, their risks, and the trading strategies, how we can make money on exchange rate fluctuations, basically. So this is like the main purpose of the course. How to make money on exchange rate, how to forecast exchange rate fluctuations, how to trade foreign currencies and earn profits on that. Okay, so the textbooks are like the main textbook is Krugman, Obstfeld, and Moritz, which has this abbreviation chapter 14 and Mark chapter 1. But this is just the introductory stuff, just the description of the description of the foreign exchange market and main terminology, nothing else. I will upload the textbooks on the Google folder, and I will post you the link to Telegram. So I remind you once again that you all need to sign up to the Telegram channel. Okay, so if you haven't signed up, the link to the Telegram channel is at the beginning of the chat today. And I will post all the most important information about the course on the Telegram channel. Okay, guys, if you have any question, you may ask now, or otherwise, let's finish.
Алло, меня слышно?
Да.
Здравствуйте, там вопрос в чате вот по поводу записи лекций, куда они будут выкладываться. Спасибо.
Ну, я сказала, что я их, конечно, записываю. Ну, как правило, выкладываю в Telegram, туда же высылаю ссылку. Но все-таки предпочтительно, чтобы вы слушали именно во время лекции, а не неизвестно когда. Так, есть ли еще какие-то вопросы? Первый семинар у нас будет ориентировочно через 2 недели. То есть после следующей лекции. Да, книги, да, я скину все. Я создам какой-нибудь Google фолдер, туда всю информацию закину и пришлю ссылку в Telegram. Ну, окей, если вопросов больше нет, тогда до встречи в следующий вторник в это же время. Да. Что будет? Вы про что? Вы имеете в виду про хеджирование с помощью форварда? Разные. То есть там будут и математические задачки, где что-то надо посчитать, но мы это еще просто просто пока не сделали, что-то там конвертировать, куда-то посчитать прибыль и так далее. И будут описательные вопросы, типа эссе, ну, то есть абсолютно разные. В этом курсе больше, наверное, будет essay-type questions. На понимание, что, как захеджировать риски, что куда инвестировать и так далее. Ну, окей, тогда до встречи через неделю. До свидания.
До свидания.
Спасибо, до свидания.